Hello everyone. In this video I'm going to show you how to form an optimal risky assets portfolio, and I will also show you how to make the best portfolio choice between bonds, stocks, and risk-free assets. Now let's take a look at this picture. And once again, the picture that you see in this module is more likely a two-dimensional picture, show you the relationship between risk and return of certain stocks or a portfolio. And here you see on the x-axis, that is the risk, which is measured by standard deviation, and y-axis, that is expected rate of return of financial assets. And here we have a pink curve, and as you know, this is an efficient frontier. And on this efficient frontier, you see all the efficient combination between stocks and bonds. And other than this pink curve, you also see capital asset allocation line, and this capital asset allocation line determines the combination between risky asset and a risk-free asset. And here we can draw several different capital allocation line from the risk-free rate of 3%. And as you see, we have a gray line that cross this pink curve. And here we have a cross point, and that cross point represents a unique combination between stocks, bonds, and risk-free asset. And also we can draw a line that is called a capital allocation line, and this line actually crosses the point where you see the standard deviation is minimized on this pink curve, and we call this as capital asset allocation line that minimize the risk. So our goal here is to have an optimal choice of the portfolio, risky asset portfolio between stocks and bonds, given we have certain proportion of assets invested in risk-free asset. And so by saying optimal choice of portfolio, what do we mean? Optimal could be best return or lowest risk, right? And as you see, if we draw a line that crosses the pink curve through the point that has least amount of risk, that in this case we are minimizing risk. And this is the criteria for choosing so-called optimal portfolio. But this might not be the best criteria, because investor may look for higher return, not just to minimize the risk. And we can also draw a line that can achieve highest rate of return, but as you see, from a professional's perspective, what really matters is a balance between risk and return, right? And here we can define optimal as the best risk-return trade-off. Best return-risk trade-off. So previously we used the Sharpe ratio to measure trade-off between risk and return, and the higher the Sharpe ratio, the better the risk-return trade-off is. So if we define this as the criteria of optimal risky portfolio, then our criteria would be to found the best choice where the Sharpe ratio is the highest number. So that is our criteria. So in order to make this happen, what should we do? Well, we should move this capital asset allocation line to the left to a point where this capital asset allocation line tangent to this pink efficient frontier, so that the slope of this capital asset allocation line can be maximized, right? And the slope of capital allocation line is equivalent to the Sharpe ratio. So when you look at this picture, you see, okay, this is the process that we utilize to find an optimal portfolio between stocks and bonds. Right? And this point can be found by moving this capital asset allocation line to the left, right, to a point where it is tangent to this efficient frontier. And on this point, we call this as portfolio O, or optimal portfolio. Right? And on this point, you see a very unique combination between stocks and the bonds. Right? And this unique combination of stock bonds can achieve the best risk-return trade-off, which is measured by the Sharpe ratio. And in this picture, the Sharpe ratio is simply the slope of this capital asset allocation line. And mathematically, how can we determine that weight? Well, here is the equation that you can utilize. And this W is the weight for certain security. And here we have two securities. One is stock, the other one is a bond. And here WB means the weight on the bond. And weight of bond follows a very complicated equation. Right? But don't worry. No matter how complicated this equation is, it only has 5 factors in this equation. What are the 5 factors? Well, first one is risk return. The expected rate of return for both stocks and bonds. So this is the rate of return for bond, and this ERS is expected rate of return for stocks. So those are expected rate of return for both bonds and the stocks. And 2 other variables are standard deviations. Standard deviations for stocks and standard deviation for bonds. And the 5th one is this rho, the correlation coefficient between bonds and stocks. Of course, we have the last variable here is risk-free rate of return. Right? So don't worry how complicated this equation is. What you needed to do is to follow this equation, to plug in the numbers and do the calculation to find the weight for the bonds. And once you found the weight for bonds, you can easily calculate weight for the stocks, right, by following this very, very simple equation. Right. So this optimal risky portfolio can be found by figuring out a very unique combination between stocks and the bonds, and the weights for bonds and the stocks should follow the equation that you see here. Right. So now you know how to make portfolio choice. And here we follow two-step procedure. First one is to find this risky asset portfolio, which is optimal in terms of risk and return trade-off. Right? And here we make a decision between a mix of bonds and stocks to make sure that risk return is optimized. And once this job is done, then we can find this tangent point. It's point where this capital asset allocation line tangent to this efficient frontier. As you see on this point, portfolio O point, the expected rate of return would be around 10.15%. The expected rate of return is 7.16%, with standard deviation around 10.15%. That's a very decent choice. And the second choice the investor need to make is the combination between risk-free asset and risky portfolio. This optimal risky portfolio. Right? And how do we make the decision? Well, there are many decisions that you can make, depend on your risk preferences. If you prefer to bear more risk, then you allocate more money in this optimal risky portfolio. And if you prefer to have lower amount of risk, then you should invest more money in this risk-free asset. Right? So any point along this capital asset allocation line are equally good in terms of risk return trade-off, and just that the risk preference of investor will affect the eventual combination between risky asset and risk-free asset. Right? So, in order to choose a optimal portfolio, investor need to follow two-step procedure, and this two-step procedure is so-called separation property, which means that the investor should separate the entire decision into two different tasks. First one is to make decision on this optimal risky portfolio to find the best combination between stocks and bonds. And once you made this choice, then the second step is to make personal choice to find the best mix of risky asset and risk-free asset. It depends on your personal risk preferences. And once again, if you prefer to have higher return, which means you have capability to bear more risk, in that case, you might want to allocate more money in risky portfolio. But if investors are very conservative and they prefer to have a lower amount of risk, then they should allocate more money in risk-free assets than risky portfolio. Right? So this on this figure, you see investors can make a decision between portfolio C or portfolio O, or any portfolio lies on this capital asset allocation line, simply based on their personal preference of risk return trade-off. If they want to bear more risk, they move along this capital asset allocation line to have more exposure to risky assets. But if they prefer to have a lower amount of risk, then they should allocate more assets in risk-free asset. Right? So that is a discussion on how to make a portfolio choice from optimal the optimal combination of risk and return trade-off. All right. So to conclude this chapter, I want you to look at one extra thing, that is single index stock market model. And single index stock market model is a model that investors frequently use to get some sense on how to handle the risk in a specific stocks, and how can we distinguish between the market risk and firm specific risk. Right? So here, let me show you the equation. An equation here has four components. On the left, that is return for any individual securities, RI, that is return in any individual security. And the return on individual securities have three components. First one is beta I times RM. What does that mean? This RM is return on the market. And this beta I measure the correlation between individual stock and the market. And simply put, beta I times RM reflect the market risk for individual company. A company that has higher market risk tend to have higher beta. So higher the beta, higher the market risk is, and this is the first factor determining individual stock return. And the second factor here is the alpha. Alpha is good stuff. Alpha means access to return that investor can get from the financial market. And generally speaking, this financial market is not a complete or perfect place. Therefore, sometimes investor can capture excess return from the market. And this alpha measure the excess return that investor can get from smart investing on the financial markets. And the last term is EI. That is the error term from this regression formula, and this EI represents firm specific risk. Or diversifiable risk. So in this equation, you see this diversifiable risk is captured by this EI, or the error term, in this regression formula. And this beta capture the market risk for individual companies. And in the next chapter, we will have more detailed discussion on the single index stock market model. And let's go ahead to practice some homework questions. Alright, so the question we are going to cover is the question in Chapter 6, Diversification and Efficient Frontier. Number 13. Let's start with number 13. Okay, risk that can be eliminated through diversification is called what kind of risk? Well, here we know that so-called diversifiable risk is due to different firm characteristics, and it's also called a firm-specific risk or unique risk, diversifiable risk or unsystematic risk. Right? It has several nicknames, and the answer here is D. All of those. It's a unique risk, it's firm-specific risk, it's diversifiable, and it's also called unsystematic risk. Number 14. We have a table showed you 3 different scenarios and returns on 3 different securities. Security A, B, and C. Right. Let's look at this. Let's look at this table. So, in terms of security A, when recession comes, the security A perform better than the average. And when it's normal situation, it's equal. But if economy booms, then the return for security A is less than the average. It's a little odd, right? Because typically you would say stock tend to perform better, but this one actually goes the opposite. And for security B, the return is always the same, no matter what happens. And for security C, when recession comes, it underperforms, and when economy booms, security C outperforms. So security C is a typical company that you will see on the financial markets. It's a very typical pro-cyclical company. And the security A goes the opposite, right? And it's a very typical counter-cyclical stock. So here we have 3 choices. A, the first one, the covariance of stock A and B is 0. 2, correlation coefficient between security A and C is negative. And number 3, the correlation coefficient between security B and C is positive. Right. And I think here covariance between security A and B is 0 is correct, because security B doesn't change at all, and it's a typical risk-free asset. And the covariance between any risky security and risk-free security is 0. So first statement is true. Second one, the correlation coefficient between A and C is negative. Well, correlation coefficient measures the co-movement of 2 different securities, and the negative value of correlation coefficient means those 2 securities tend to move on the opposite direction, and this is the case that you observe in this table. So second statement is also true. And the third one is not. B and C correlation coefficient between B and C should be equal to 0. So the best answer is B. First and second statements are true. Number 15. An investor's degree of risk aversion will determine his or her what? And the best answer here is C, optimal mix of risk-free asset and the risky assets. That's the second step that the investor need to go through when they make optimal choice for their portfolio. Number 16. Which of the following statistics cannot be negative? Covariance, variance, expected rate of return, correlation coefficient, and the only thing cannot be negative is variance. How do we calculate the variance? Well, we take a square. Square of all the differences. Those differences can be positive, can be negative, but once you take square of everything and put them together, the value of variance must be positive. Must be positive. So B is correct. Variance cannot be negative. Number 17. Asset A has expected rate of return 20%, standard deviation 25%, risk-free rate 10%. What is the reward to variability ratio? So this reward to variability ratio is also called Sharpe ratio. How do we get that? Well, we take a ratio of excess return, which is expected rate of return minus risk-free rate, 20% minus 10%, that's 10%, divided by standard deviation of 25%. So it's 20% minus 10% divided by 25%. That gave you 0.4. Right, so A is the best answer. Number 18. What is equal to the square root of systematic variance divided by total variance? And this is just the verbal description of correlation coefficient. Answer is B. Number 19. The correlation coefficient between two assets equal to what? And then once again, it asks you the definition of correlation coefficient. That rho equals covariance divided by the product of standard deviations. So D is the only correct answer. Number 20. Diversification is more effective when security returns are positively related, negatively correlated, high or uncorrelated, and the best answer to be negatively correlated, where you will have a negative value for that rho so that the variance can be reduced significantly when you combine several different risky assets together. So the key for diversification is this low value for correlation coefficient. Ideally, negatively correlated. Number 21. Beta is a measure of security responsiveness to the answer is C. Market risk. Stock that has higher beta tend to respond to market risk more significantly. 22. The risk tag that can be diversified away is unsystematic risk, or firm-specific risk, or unique risk, or diversifiable risk. So here, answer is B, firm-specific risk. Right? And market risk, also called systematic risk, and those are risks cannot be diversified away through portfolio. Number 23. Market risk is also called what and what. So here, market risk have several nicknames. It's systematic risk because this is the risk borne by the financial market. It's a systematic risk. And also this risk cannot be diversified away. Right? So here, you already see the best answer, B, systematic risk, non-diversifiable risk, or market risk. They are the same thing. Number 24, firm-specific risk, also called what? This is very similar to number 22. Firm-specific risk, also called unique risk, unsystematic risk, or diversifiable risk. And only D is the best choice. Number 25. Suppose that a stock portfolio and a bond portfolio have a zero correlation. This means what? Well, zero correlation means they do not move on opposite direction or positive direction. There's no clear pattern in terms of their co-movement. So here, the return on stock bonds portfolio tend to vary independently of each other. That's zero correlation means. They do not correlate it to each other whatsoever. Therefore, the return tend to vary independently of each other. So B is the best answer. Number 26, you put half of your money in stock portfolio that has expect rate of return 14%, standard deviation 24%, and the rest of the money in bond portfolio that has expect rate of return 6%, standard deviation of 12%, and the row, the correlation coefficient is 0.55. So it asks you the standard deviation of this resulting portfolio, right? So the standard deviation for stock 24%, standard deviation for bond 12%, right? So what would be the standard deviation of this portfolio? You have four choices: more than 18%, less than 24%, equal to 18%, more than 12% but less than 18%, and last one is equal to 12%. Right. So here you probably want to do a little calculation. This variance of portfolio equals weight for first one, half, which is 0.5, right? 0.5 square, and times sigma 1 square, 0.24 raised power. That's first term. Then plus weight for the bonds, raised power, times standard deviation 12%, 0.12 take square, and then the third term 2 times W1 W2 0.5 sigma 1 0.24 and the sigma 2, and last one row 0.55. Right? And once you get a variance, do not forget to take standard deviation, which is square root of this variance. Right? Raised power of 1.5, or square root of the variance. Right? And you will find the answer falling is something between 12% and 18%. So that's why C is correct. Right? So here, do not take guess. Simply do the calculation. When you do calculation, do it slowly and carefully. And once you get a variance, please take the square root to get its standard deviation. Number 27. A portfolio has two stocks, A and B, standard deviation. Here 24% for A, 18% for B, and the weight is 60% versus 40%. And the variance is 0.38. And it asks you to solve for the correlation coefficient. Alright. So here you follow the similar formula that you used here, calculating variance, and just the difference here is you know the variance here. The variance is 0.038, and the only thing that you need to solve is this row. So this 0.038 equals weight 0.6 raised power times 24% take square, then plus 0.4 W2 square times sigma 2 square, which is 18% square, and plus 2 times W1 W2 sigma 1 24% and a sigma 2, and the last item, this row, correlation coefficient. Right. So here you have one unknown in this formula, and you do the calculation to solve for this correlation coefficient, and the answer is A. Number 28. A portfolio has two stock A and B. Standard deviation here is 35% for A and 15% for B. Correlation coefficient is 0.45. Weight 40% for A and 60% for B. It asks you the standard deviation of this portfolio. Right? So here you have all 5 factors. Right? W1, W2, sigma 1, sigma 2, and this rho. So you use this variance formula to do calculation. Once you get a variance, do not forget to take square root to get standard deviation. Very similar to number 26, and the answer is B. I want you to do the calculation. Make sure you get 19.76 as standard deviation. Number 29 is about optimal risky portfolio, and your job is to get a weight for bond and for the stock. Right? And here you need to find all 6 factors. And I mean, if you forget about this equation, that's okay. You can open the textbook, look at the lecture notes to get equation, and your job is to plug a number in the right place to get answer for WB. WB is the weight for the bond. Right. So here is A and a B, and a B is not bond, another stock. It's okay, and WB means the weight for stock B. And here you have rate of return 21%, 14% for A and B, standard deviation 39% versus 20%, right? And also you have correlation coefficient 0.4, and the last one is risk-free rate. So you have all 6 variables here, and put numbers, plug numbers into equation to do the calculation. And here WB is 71%, and W for A should be 1 minus 71%, or 29%. But here it's not the answer that you need to put there, but because it asks you, the question asks you the expected rate of return on this optimal risky portfolio. Right? So here, once you get the weight for A and B, you still need to do actual calculation to get expected rate of return on this portfolio by doing weighted average. Right? So weighted for stock A is 29%, and stock A has expected rate of return of 21%. Stock B has a weight of 0.71, and stock B earns return of 14%. So you do weighted average to get expected rate of return for this optimal risky portfolio, which is around 16%. Number 30. The part of stock return that is systematic is a function of which of following variables? Stock return is systematic function of which of following variables? A is volatility in excess return stock market. Second one, sensitivity is stock return to change in the stock market. That is actually the beta. Right? And the third one, the variance in the stock return that is unrelated to the overall stock market. Right? So number 3 here means the variance that is unrelated to the overall stock market, that is a firm specific risk, right? Or the error term in that single index stock market model. So the part of stock return that is systematic means it's correlated to the market. Therefore, number 3 shouldn't be here. So the best answer is 1 and 2. Volatility in excess of the stock market. Right? That's market premium, and the sensitivity is the beta. So that's B, 1 and 2 only. This is a pretty hard question, number 30. 31. Stock A has beta 1.2, stock B has beta of 1. Then return stock A are more or less by how much sensitive to the change in the market than as return stock B. So here, this beta measures market risk. Higher beta means more risky. And here, 1.2 versus 1, of course, stock A is 20% more risky or more sensitive to the change in the market than stock B. So A is the best answer. 32. The term excess return refers to what? That's the difference between rate of return and risk-free rate. Right, so B is the best answer for 32. 33. A stock has a correlation with the market of 0.45. That means beta is 0.45, right? Standard deviation of the market is 21%. Standard deviation of stock is 35%. And it asks you, what is the beta? What is the beta? I'm sorry. This correlation with the market 0.45 is covariance, not the coefficient. Correlation coefficient. And it asks you what is the stock beta. So here we follow the equation of beta. Beta equals covariance between individual stock and market divided by standard deviation of the market. Right? And we can manipulate this equation a little bit and express this in terms of rho, standard deviation of individual stock, standard deviation of the market. And once you get this equation, then you plug the number into equation to get the answer. 0.75 would be the answer of stock beta. That's number 33. 34. Diversification can reduce or eliminate what kind of risk? Well, that's diversifiable risk, or non-systematic risk, or unsystematic risk, or firm-specific risk. So only C is the correct choice. 35. Some diversification benefits can be achieved by combining securities in a portfolio as long as the correlation between security is, you say it has to be negative. Well, if it's negative, that's very good. But even when it's positive, portfolio can still generate diversification effect. Okay. And only when this correlation is equal to 1, there will be no diversification effect. So as long as correlation coefficient is less than 1, there will be diversification effect. So answer is B, less than 1. 36. If an investor does not diversify his portfolio and instead puts all his money in one stock, the appropriate measure of security risk for that investor would be, here investors do not diversify, only invest in one stock. Therefore, he or she cannot eliminate or reduce firm-specific risk. And the best measure for the risk for this investor should be standard deviation, because standard deviation incorporates both firm-specific risk and market risk. What about the investor that holds portfolio, a well-diversified portfolio? And if that is the case, all those firm-specific risks can be diversified. The only thing that is left that investor need to worry about is the market risk. And in this case, the best measure for security risk in that portfolio should not be the standard deviation, but the beta. Beta is used to measure market risk. So number 36, with no diversification, the best measure for risk is standard deviation. Number 37, which of following provides the best example of systematic risk event? Systematic risk event means the event that will affect entire stock market, and not just one or two companies. A strike by union worker hurts firm's quarterly earnings. Okay, that's a firm specific. Mad cow disease in Montana hurts local ranchers and buyers of beef. And that will affect beef business in certain sector, but it won't affect everything in this economy. So B is not. C, the Federal Reserve increased interest rates 50 basis points. Well, this is a event that will cause entire market to change, not just to an industry or a company. It's market-wide event, and any risk caused by this event should be market risk event or systematic risk event. So C is the best answer. And D is not senior executive. Stole $10 million. Well, that's individual company's event. Number 38. Decreasing the number of stocks in a portfolio from 50 to 10 would likely to increase or decrease what? And the more securities you have, the more diversification effect that you can enjoy. And here you reduce number of security from 50 to 10, so that the portfolio may not be well diversified. Therefore, it's very likely that unsystematic risk may increase, which leaves B as the best answer. Number 30. Now here's a table. You have R square, you have standard errors, you have coefficient. Well, what is that? That is a regression results table. Regression results table. Right? And here the regression is based on single index market model. We run regression between individual companies' return and the market return. Right? And the only thing that you need to pay attention to is this coefficient on the market, which is equal to 1.32, and this 1.32 is the beta of individual company. Right? 1.32 means this individual company is 32% more riskier than the market average. Right? So remember, this coefficient on the market is the regression results for beta. Right? Higher beta, more risky than what? Than the market average. So answer is A. 1.32 here means the individual stock is 32% riskier than the market average. We are almost there. Number 40. Which of the following correlation coefficient will produce least diversification effect? Least. Well, you look at a correlation coefficient and you know that the lower the value, the better the diversification effect. Ideally negative, but even when it's positive, it still generates diversification effect, just not that much. So here the answer is D. This is the highest value for correlation coefficient, therefore the diversification effect would be the lowest one. Number 41. What is standard deviation portfolio of two stocks given the following data? A, standard deviation 18%, B, 14%, it's standard deviation, and 40% in A, of course, 60% in B. Correlation coefficient negative 0.23. So it asks you standard deviation of this portfolio. Right. What should we do? Well, do the calculation. Do the calculation like number 26. Number 26. Right? W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus 2 times W1, W2, sigma 1, sigma 2, and rho 1, 2. And rho 1, 2 here is negative 0.23. Right. And once you get a variance, do not forget to take the square root to get the standard deviation. Right. So that concludes chapter 6.